In today's rapidly evolving financial world, investors face a pivotal question: crypto versus traditional investments. Which is the better bet? Cryptocurrencies, with their meteoric rise and technological innovation, have shaken up traditional investment markets. This debate aims to shed light on the advantages and disadvantages of both approaches, exploring the potential rewards and risks associated with each. As we move on, don't forget to hit that subscribe button below. So, let's begin. Crypto investments offer unique advantages such as 24/7 liquidity, allowing investors to trade at any time. The transparency of blockchain technology reduces fraud and enhances security, while the potential for substantial returns in the highly volatile crypto market appeals to risk-tolerant investors. Additionally, cryptocurrencies can serve as a hedge against traditional market volatility and economic uncertainties. Furthermore, crypto investments offer a level of accessibility that traditional financial markets often lack. With only an internet connection and a digital wallet, individuals from diverse backgrounds and locations can participate in the crypto ecosystem. However, it's essential to keep in mind that these advantages come with their own set of risks, which we'll explore further in this discussion. Traditional investments, including stocks, bonds, and real estate, offer a proven track record of consistent and predictable returns over the long term. They benefit from well-established regulatory frameworks that provide investors with a sense of security and protection. Compared to cryptocurrencies, these assets tend to exhibit lower levels of volatility, making them a preferred choice for risk-averse investors seeking stability in their portfolios. Additionally, traditional investments often generate income through dividends, interest payments, or rental income, offering a reliable source of cash flow. The extensive historical data available for these investments facilitates informed decision-making, while their widespread acceptance in financial planning strategies makes them an essential component of most diversified investment portfolios. Investing in cryptocurrencies carries inherent risks and concerns. The extreme price volatility of digital assets can lead to substantial gains but also precipitous losses, making it a high-risk, high-reward venture. Moreover, the lack of regulation and oversight in the crypto market can expose investors to fraud, scams, and market manipulation. The digital nature of cryptocurrencies also makes them susceptible to hacking and security breaches, posing a significant threat to the safety of invested funds. Additionally, the anonymity associated with crypto transactions raises concerns about their use in illicit activities such as money laundering and tax evasion, potentially leading to increased regulatory scrutiny. The rapid evolution of the crypto landscape and the emergence of numerous new tokens and projects make it challenging for investors to assess the long-term viability of their investments, adding to the overall uncertainty and risk associated with crypto investments. Traditional investments, while historically reliable, are not without their own set of risks and concerns. Market volatility can impact the value of stocks and bonds, potentially leading to losses for investors. Economic downturns, recessions, or unexpected events can trigger significant market fluctuations, affecting portfolios and retirement savings. Additionally, the low interest rate environment prevalent in some periods can reduce the returns on fixed income investments like bonds. Inflation erodes the purchasing power of money over time, and if investment returns fail to outpace inflation, investors may find their wealth diminishing in real terms. Lastly, market sentiment and external factors can influence investment decisions, sometimes leading to speculative bubbles or irrational exuberance. Thus, while traditional investments offer stability, they require careful consideration and diversification to address these risks and concerns effectively. The realm of cryptocurrency operates in a complex regulatory landscape. Governments and financial authorities worldwide are grappling with how to regulate digital assets effectively. The absence of comprehensive regulations in some jurisdictions can expose investors to potential risks, including fraud and market manipulation. On the other hand, overly stringent regulations can stifle innovation and hinder the growth of the cryptocurrency industry. Additionally, the decentralized nature of cryptocurrencies, while providing benefits like security and transparency, also presents challenges in terms of law enforcement and consumer protection. Security is another critical concern, as cryptocurrencies are susceptible to hacking, theft, and fraud due to their digital nature. Ensuring the safety of digital wallets and the robustness of cryptocurrency exchanges remains an ongoing challenge, and investors must exercise caution and employ stringent security measures to protect their assets in this evolving landscape. Diversification plays a crucial role in investment strategy, whether in traditional assets or cryptocurrencies. It involves spreading investments across different asset classes or cryptocurrencies to reduce risk. By diversifying, investors can mitigate the impact of a poor-performing asset on their overall portfolio, as gains in one area may offset losses in another. In the context of cryptocurrencies, diversification can help manage the inherent volatility and uncertainty of the market. Holding a mix of different digital assets can reduce the exposure to the extreme price swings that often characterize individual cryptocurrencies. However, it's important to note that diversification alone does not eliminate all risks, as the entire cryptocurrency market can be influenced by macroeconomic factors or regulatory changes. Still, it remains a valuable strategy for investors looking to balance potential rewards with risk management in both traditional and crypto investments. In conclusion, both avenues offer unique advantages and risks, and the right choice ultimately depends on individual goals and risk tolerance. To stay informed and make well-informed investment decisions, we encourage you to subscribe to our channel. Thank you for tuning in, and we look forward to having you as part of our growing audience.